discussing what is a credit score and what does it do for you and how can you use it to benefit you in the future or now. Today I'm going to tell you how it is very important, especially to start early when you hit 18 pretty much, to start building your credit score. Credit score is pretty much, the best way I like to describe it is it's pretty much history and trust. That's the best way to explain what credit is. It's pretty much history and trust. Credit scores are broken down into 5 different categories. So we're gonna start with the first one, and we're gonna go from the lowest percentage to the highest percentage that builds up the full circle of the credit score. All right, number 1, types of credit. This is only 10% of your credit score, and what it is pretty much seeing what type of credits you have out, whether it's a credit card, a car loan, a mortgage loan, a student loan, any loans or any credit you borrow from a company, whether it's a credit card from, Target or Macy's, Best Buy, or a regular Master, Visa, American Express credit card. This is 10% of your credit. Number 2, it's another 10% of the chart, and it's new credit. And what that is every time you apply for a new credit card, it shows up. It affects your credit every time you apply for a new credit card or a new loan. When you're shopping for a car loan or a mortgage loan, you have like about a 2-week time frame to shop around in different, lenders, different banks to get a loan from when you're doing big purchases like a car or a home, and it won't keep hitting your credit compared to if you were applying for credit cards back to back. Those are when you get hit. All right, and number 3 is 15%, and it's credit history. So to me, this is one of the easiest things to keep track of by simply never canceling the first credit card you ever own. So when you're 18 years old, you go out there and you get yourself a $200-300 credit card limit. That's probably what you're going to qualify for because you're brand new and you have 0 credit and you're trying to build your credit. When you get this credit card, never, ever, ever cancel it for life, pretty much. So what it does is, the credit history is pretty much based off your oldest credit card to your newest credit card. So let's say fast forward, you're 28 years old, 10 years later, and you still have that same credit card, but during those 10 years, you applied for a couple more credit lines, and let's say now your newest one is 2 years old. So they're gonna take 10 years and 2 years, find the average, and that's gonna be the length of your credit history. So you always wanna keep the oldest credit card, because if you think about it, 30, 40 years down the line, if you still have that card, even if you get a brand new card, it's always gonna go back all those years to find your average. But if you cancel it and then you get a new one, then now your range is pretty much 1 month or how many days. But in between, you can definitely cancel those cards. I don't see no point of holding 5, 10, 15 credit cards because you don't want to cancel it because you think it's going to affect your credit. It might take a little hit, but I'll tell you this, it'll go right back up if you are responsible with your credit cards and you pay them on time and you use them wisely and not overcharge them and spending money you don't have, So you definitely don't want to live the lifestyle of spending to save. That's just stupid, pretty much. All right, number 4, amounts owed. That is about 30% of your credit score. And what that is it takes all the credit cards you have that you owe, right? Your loans, your credit, and it pretty much breaks down from what your credit line is and how much you own. And they're gonna tell you the percentage of that, right? So Rule of thumb for me is always stay under 30%. Like that's it. You don't want to have a 100K credit line and then you're at 60%, meaning you spent $60,000 out of $100,000 credit limit. So, wow, that's just ridiculous. But people do that. I mean, people max out their credit cards all the time and they live in debt forever. And they never get out of the cycle because they're constantly getting pushed back by these APR interest rates that's 20% and up. And for people who owe thousands of dollars, hundreds of thousands of dollars, they can never pay that down, you know, and that leads to file bankruptcy or just never paying and going to collections. That's what you want to avoid, because when you go there, it's really, really tough to get out of it. All right, and the last one, the biggest chunk, coming in at 35% is your payment history. So you see, like I told you in the beginning of the video, is it's pretty much all about history and trust. They're trusting you with their money. These banks, these lenders loan you money every single day and they expect you to pay them back, right? Whether you're paying them installments every month or you're paying it off as you use it, they're trusting you to pay back what you owe because it's not your money technically, you're borrowing it, right? So trust goes a long way. Rule number one, never, ever, ever pay late, because that sticks to your credit and it harms your credit very, very bad. You do not want to make late payments. You always want to pay on time. If possible, pay before, because it just shows a history of you paying on time, paying early, especially if you're paying way above minimum. I recommend always going above the minimum payment. So let's say you have a $500 credit card and you owe $100 and the minimum payment is only 20 bucks. I mean, if you can knock it out, go ahead and knock it out. But if not, double, triple, quadruple it. With time, as they see your history build with them, as they see you're trustworthy, you're holding your credit in good condition, in good standing, then they're more likely to increase your credit as well. And that's when you start building your credit, because what happens is when they raise your credit score, so does your limit and your percentage, your ratio of amount owed goes lower, right? Say you had $1,000 limit and you spent $200, right? So your ratio right there is 20%, right? You have 20% owed. Now, if they increase that to like $2,000, now that 20% becomes 10%. You see what I'm saying? So now your credit actually improves because you have more credit and it shows you owe less. And for the people that's irresponsible, credit cards take advantage of those people. Those are the people that, can't stay on a budget, spends money they don't have, pretty much a slave to the lender because they just don't have discipline. You see, credit card's a good thing, right? When you build your credit, you can do more things. And I always say, hey, if you don't have 100% of the cash, you better have good credit, because credit talks. Nowadays, credit talks more than money, because a lot of people don't walk around with money, or they don't have all the money to buy big things like cars or your house, boat, whatever you may be. When you're talking about these big purchases, you don't have that kind of cash available. And if you do, great. You know what you do? Benefit from it. This is my thing. When I want to buy something big, whether it's a TV or a new camera or a new phone or whatever it may be, that's a couple grand, I save that money. Then when I have it, I use my credit card, and then I pay it right away before the month is even over. So I get to take advantage of not only of the reward points or the miles or cash back, but I also show them, hey, look, I can borrow this amount of money and I can pay you right back. So trust me more. You know what I mean? That's why I say it's all about a trust and history. That's what this whole thing is about. That's what credit scores are built off of. But use it to your advantage. There's a lot of credit cards out there that give you these bonuses, that give you these no interest credit cards. Those are my favorite. I'll tell you this, I've never, ever paid interest on a credit card my entire life. You know why? Because I always use it to my advantage and I'm responsible with it. Like I tell you, if you're gonna use it, make sure you got the money and then you pay for it. It's that simple. You're gonna go grocery shopping or you're gonna go buy these shoes or whatever you're gonna go buy, save for it. Don't spend money you don't have. That's how people get destroyed by credit cards. Is they're like, oh wow, I got a new shiny plastic car that gave me $10,000. Oh my goodness. That money is not yours. You're just borrowing it. But you go out and you max it out and then you can't pay for it. And now you're like, oh man, what am I gonna do? So not only do you owe them the $10,000, but they're gonna hit you with the interest every month if you have a card that doesn't have no interest. Because those cards usually last 12 months, 15, you might get a 24-month one, but they run out, right? So you're over here maxing out this card saying, hey, I don't have no interest for a year or 2 years. And then when you get there, you still don't have the money. And now you're constantly paying interest month after month after month. So your 10 grand becomes 15, 17 grand by the time you're done, because not only are you trying to pay it down, but then you keep adding on to it. So it's gonna take forever to get rid of it. So play it smart. If you're gonna get a card, use it for your advantage, build your credit, build your history, build your credit limit with these companies so you can take on bigger things, right? You start with these credit cards first, small limits, then they grow, and then you move to cars, then you move to houses, and then now the bank and you have a relationship. These credit cards know who you are. They look at your credit score. You get approved for anything you want. That's where you want to be. You don't want to be that guy who has that 300 credit score. By the way, credit scores go from the lowest 300, I believe, is what you start off, to 850. Now, that's a high range, right? So 850, you're pretty much in excellent credit, and 300, you're at poor beginner credit. You know, that's where you start. So to break that down for you, 300 to 499 is considered poor credit, very, very low, bad credit. Then they say 500 to 600 is still poor credit. 600 to 660, they say is fair. And that line right there is usually the line where most people are. Now you want to step it up and get to the category of 661 to 780. Now, a lot of people in that range is when, you know, you pretty much qualify for a lot of credit cards. You can qualify for car loans easier, for home loans easier, pretty much a lot of different things you can qualify for. But of course, you want to pass that. You want to get to the 781, 850 range, which is pretty much excellent, right? So when they see that, they're like, oh man, no hesitation. Here you go. What do you want to buy? How much do you want to borrow? It's all yours. So you want to get to that category, and it's going to take you a while because, like I said, I broke down the chart for you, and you're going to see that, you know, only time builds credit because, like I said, it's history and it's trust. You can't just earn that in 1 month, right? You got to build that over time, whether it's signing bonuses, reward points, money back, miles, gift cards. It's limitless to these credit cards, but those cards usually fall in the categories of the excellent credit people, you know, the ones that they don't have to worry about. You know, the people who have poor credit, they're not going to get those cards and benefits. They're going to get the ones that nobody cares about and nobody wants, right? The one where you start off at with a small minimum limit. So I hope this information helped you. This was something I took to heart when I was younger because I noticed that I said, man, you know, we grew up poor. We grew up with not a lot of money, and I seen that for myself, and I said, you know, if you don't have money or if you don't have all the cash to buy certain things, then you gotta have credit. It's that simple. And having good credit has opened up so many doors for me. I'm in real estate, so I I like to buy and sell homes for myself. I like to invest. I like to be able to qualify for these homes without having all the capital to provide, without having all the capital to purchase these homes. So credit is definitely a big thing. They don't teach this in school, which they should, but they're not going to teach you this in school because they're like a broken record, just replaying the same information over and over again to things that you're not even going to use in real life, where building credit is something you need to know about: how to hold your money, how to take care of your finances, how to pay your bills. These are the type of things that they should be teaching children. But on this channel, that's what we're going to be teaching you. We're going to teach you all of those things and how to improve yourself and not to drown yourself in debt, especially in the early age when you first get credit. You don't even know what to do with it, right? You're just like, oh, what is this? It's free money. This is new. I never had this before. But be careful, be wise. If you start smart in the beginning, trust me, it's just going to get better and better from there on out. If you like this video, please subscribe. Push the like button as well, notification with the bell. And more videos are here to come to educate, to help you, and to get you to that financial freedom.